All right, let's dive right into this explainer. We're tackling the ultimate investor question surrounding Costco right now. I mean, we all know the retail giant for its bulk goods and, of course, those famously cheap hot dog combos. But behind the scenes, there's a really fierce point-counterpoint debate happening among market analysts. The big question is, are they poised for a massive financial breakout, or are they actually incredibly vulnerable to mounting global pressures? Today, we're looking directly at the source data driving this exact debate. To figure this out, we're going to break things down. First, the overall Costco tug-of-war. Then, the bull case for relentless growth, countered by the bear case on macro threats. After that, we'll look at the bull's argument for the moat, the bear's warning on margin pressures, and finally, the final verdict. All right, Section 1, the Costco tug-of-war. Let's see how these opposing forces frame Costco's current financial reality. This tension is brilliantly illustrated right here. On one side, you've got the bull case. Undeniable internal financial wins, like pulling in a staggering $69.15 billion in net sales in just the third quarter. But right on the heels of that success, the bear case points to heavy looming external threats, things like global tariffs, lingering inflation, and rising consumer debt. The whole debate hinges on how long Costco can sustain those massive sales numbers when the average shopper's wallet is getting squeezed from every possible direction. So let's move to Section 2, the bull and relentless growth. Now, what's really surprising about this massive 21.5% jump is that it isn't for foot traffic in their warehouses. Nope, this represents their digitally enabled comparable sales for Q3 2026. For a company that's historically been known for, making you walk through giant concrete aisles to find what you need, cracking the code on e-commerce is a massive win. It shows they're successfully capturing the digital consumer, which opens up a completely new avenue for aggressive growth. And that momentum, it isn't just digital. Total net sales for the first 36 weeks of fiscal 2026 reached an astounding $203.37 billion. That is a 9.6% increase from the previous year. Just think about that for a second. For a company of this sheer mammoth size to still increase top-line revenue by nearly 10% year over year, that tells the bulls that the core engine isn't just running, it's actively accelerating. And you can see this growth happening across the entire board. Yes, net sales are up, but look at the golden goose of Costco's profitability: membership fees. Those jumped from $1.24 billion to $1.37 billion in Q3 alone. That directly fuels the bottom line, pushing net income up from $1.9 billion to $2.19 billion. The bulls argue that with an income statement showing this kind of undeniable momentum, betting against Costco is basically a fool's errand. But hold on. Let's look at Section 3, the bear, and macro threats. Yes, sales are booming, but what happens when the global economy pushes back? The bears don't really have to look far for ammunition. They just point directly to Costco's own risk disclosures. The company frankly acknowledges that sticky inflation and rising consumer debt severely threaten their model. Think about it. Even a really loyal Costco member might delay buying a new TV or upgrading their patio furniture if their credit cards are maxed out and gas prices are spiking. When the macroeconomic environment shifts, purchasing power shrinks. And hey, this isn't just about domestic inflation either. Because Costco relies on a highly complex global supply chain, things like foreign currency exchange rates and international tariffs directly threaten their merchandise costs. Let's say a tariff is slapped on imported electronics or clothing. Costco has to make a painful choice. Do they eat the cost and hurt their own profits? Or do they raise the price and potentially alienate their intensely price-conscious members? For the bears, this macro environment is a ticking time bomb. Moving on to Section 4, the bull and the moat. The bulls aren't sweating those threats. They argue Costco has built an impenetrable moat to defend against these exact risks. The first layer of that defense: sheer scale. Operating 931 warehouses across 14 countries for over 145 million members provides absolutely incredible volume purchasing power. When Costco negotiates with a supplier, they aren't buying a few pallets, right? They're buying millions of units. This lets them demand the absolute lowest possible prices from vendors, creating a buffer against inflation that smaller retailers simply cannot match. But this moat isn't just about external buying power. It's also about internal stability. They're heavily investing in two really critical areas: the workforce running the warehouses and the environmental sustainability of their supply chain. The bulls point out that by treating workers well and managing resources efficiently, Costco completely bypasses the internal disruptions that plague so many other major retailers. Just look at the data behind that workforce loyalty. Their 2025 employee agreement pushed the average U.S. hourly wage to over $32 an hour. Plus, with 94% of employees eligible for health benefits, they're seeing a massive 96% enrollment rate. By offering top-tier pay and benefits, Costco ensures a highly retained, motivated workforce. This drastically lowers turnover costs and ensures those warehouses run with absolute military precision, which ultimately protects the bottom line. And on the sustainability front, their resource management initiatives have successfully diverted over 82% of waste from landfills and reduced water use intensity by 4.4%. They've even cut 1.5 million pounds of plastic from their private label Kirkland Signature packaging. The Bulls love this because it proves Costco's sustainability efforts aren't just for good PR. They represent hardcore operational efficiencies that shrink costs and further insulate the business from external supply shocks. All right, Section 5. The Bear and margin pressures. The workforce is happy, sustainability is up, but let's pivot right back to the bear case. They're quick to point out that this entire internal ecosystem relies on a remarkably fragile financial balancing act. According to the bears, Costco's Achilles heel is that they deliberately operate on razor-thin gross margins. The whole philosophy is to pass the savings on to the member to keep them renewing that subscription. But that leaves absolutely no room for error. If supply chain costs unexpectedly spike, or if a global conflict disrupts shipping lanes, Costco absorbs that hit directly to its profitability. The 2026 data exposes exactly what the bears are worried about. Out of $69.6 billion in total revenue, a massive $60.7 billion is instantly swallowed up by merchandise costs. That leaves a relatively tiny $2.6 billion sliver for operating income. It's a total high-wire act. They're moving literal mountains of merchandise just to squeeze out a tiny fraction of profit. Any macroeconomic headwind that inflates their costs even slightly could easily wipe out that margin. Furthermore, keeping this low-margin, high-volume engine running requires immense capital. Their balance sheet carries a staggering $77.099 billion in total liabilities and equity. The bears look at this massive footprint and see liability. In a world of volatile interest rates and shifting consumer habits, steering a ship with $77 billion tied up in its operations is incredibly difficult to do quickly. If the market turns, Costco can't just easily pivot. Which brings us to Section 6, the final verdict. So, weighing the unstoppable revenue growth against those razor-thin margins and global economic threats, where does that actually leave us? That's the ultimate question you have to decide. You've seen the data from both sides. The bulls see a massive, highly efficient machine with unmatched member loyalty and soaring digital sales. On the flip side, the bears see a low-margin giant completely exposed to inflation, tariffs, and an exhausted consumer base. So, is this retail giant's moat deep enough to withstand the macroeconomic storm, or will those tight margins eventually crack under the pressure? Review the numbers, weigh the risks, and decide which side of the tug-of-war you're betting on.